there were times where they came into town. Like, for example, we were doing the renovation of a house that we bought together, and they were coming into town and they were going to inspect that house along with a bunch of other stuff. And we took the contractor's word for it that the work had been done. Right? Rookie mistake. So we all show up at that house, we walk in, and none of the work was done, even though we had said that it was done. And that seems really simple, but like, that was a learning lesson, right? Like you always gotta make sure that the work is getting done. You can't. I'm a contractor also. I own a construction company, and we do third party work. But so for all your contractors out there, like forgive me, but it's like you can't trust the word of a contractor. You can't really trust the word. You have to see it and make sure that the work is done.
You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we're all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, Chad, the investment maverick.
All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. It is early May. Sun is shining here in Nashville, Tennessee. Great to see all of you on the line here. So we have a special guest with us this morning, but before we get to Gideon, if you like anything or get value out of anything we put out here at Real Estate Runway, like it, subscribe to it, share it with someone who needs to hear it. Just pay it forward. We do this for free. This is just content that is value add for you. So if you like it, pay it forward, interact with the show. That's the only way other people like you will hear about it. So without further ado, let me welcome Gideon Pfeffer to the show with the GSH Group. I'm talking too fast. Gideon, good morning. How are you?
Good morning, Chad. Yeah, I'm doing really well today. Thank you.
It's good to have you here, brother. Good to have you here.
Thank you.
We were having a great conversation before we got started here. What I'd love to do is just kind of walk through who you are, give me the bread and soup to nuts on where you came from, what you used to do, what got you to the level of operator you are today, and kind of some of the marks on that journey, and then we'll go from there.
Yeah, thank you. I will. And I'll start, on where I am today, like to kind of, and then go backwards, and so people can understand like where I am today and where I came from. And so today I sit on I'm a CEO and managing partner of a real estate investment firm called the GSH Group. We've got just under 6,000 apartment units across about 20 communities in 6 states. It's worth about $1 billion. We've got about $325 million of our own and investor equity in that portfolio. We started assembling it in 2017, and we bought about almost 8,000 units between 2017 and now. And obviously we've exited some to sit where we're sitting today. But, I started out, as a residential mortgage broker right out of college in 2002. That was my first introduction to real estate in general. And I started, so back then the term side hustle didn't really exist, right? But my side hustle was taking some money with a friend and buying a property, distressed property, fixing up and putting a renter in, and then we sold it to an investor, like a turnkey investment. And then we took that money and bought 2 more, sold those, bought 4 more. It's like very cliche, but that was kind of like, we just started scaling up organically. And then, fast forward into the financial crisis, where we were buying houses for $5,000, $10,000, $20,000, that we were buying and selling, 100, 200 houses a year. And opportunistically, we then started assembling and aggregating single family houses in southern states. We did Tennessee, where you are. We did Georgia, Florida, Texas, the Carolinas, and sold them to institutional capital, who were just kind of beginning to see single family as a worthwhile investment. That's like 2012, 2013. It's like Blackstone had raised money around single family, but they didn't have Invitation Homes yet. So we kind of served as boots on the ground, us and others, for institutional capital. And in 2017, my wife and I decided that what's next for us. Like I was tired. We had done a lot of single family, and it was all a trader business, Chad. So like with trader business means like ordinary income, right? You're doing real estate, but you're really not benefiting from what typically folks like real estate for, which is like long-term appreciation, ongoing passive income, tax benefits like depreciation and capital gains. And so how do we take, my wife and I like vision, like how do we take what we learned over the last decade and turn it into something that'll set us up well for the future? The cash was great. But how do we be more strategic? And we felt that multifamily was the way to go. I talked to a couple gentlemen. So I'm the G in the GSH, and I talked to two other guys, the S and the H. And we started buying properties together in 2017, and we've been fortunate enough to build this big portfolio since then.
Yeah, that's fantastic. And so I love kind of where you went with, how I think a lot of us get started that way. We're, doing what we can to create something out of nothing. And that's, selling distressed properties is a great way to do that. You buy them for pennies on the dollar, sell them for more, and there's some profit there. You noted the problem that is ordinary income. And the more you do, the more you pay in taxes. There's really no write-off there there's some write-offs and expenses, but there's really no tax benefits that are substantial enough to offset that high earner income. So, right. You said something here. I mean, you rode through, I guess, the aftermath of the great financial crisis, and we're picking up some of that. Before we kind of talk about where you are today, I always loved anyone who was playing in that time. I love to ask, what's one or two things you learned from experiencing a market cycle I know you may not have been in it when it crashed, but you were definitely coming out on the other side. So any learnings you brought from that period in your life?
Yeah. I mean, I didn't have an enterprise back then like I do today. I was doing more small fee-based management and construction, and buying houses and kind of just ancillary businesses off of the house flipping that we were doing. But I did get the opportunity to work with some, and one in particular, real estate investment group that, so we were based in Michigan. We were doing a lot in Detroit, and they came in and they felt like there's something about Detroit, it's on the river, and why are things so cheap? And there's got to be something here.
Yeah.
And we were lucky enough to partner up with them and do a project where we bought about 20 or 30 single family houses together in specific locations. And then that went well. And then we started branching out into looking for non-performing notes and buying condominiums on the water and things like that. And I'll say but we, it was a different organization back then, a different partnership, but we just weren't ready. We were young, we were in our 20s, and we just didn't have the sophistication to keep up with these more institutionally minded investors, where we didn't have the right players playing the right positions on our team. And we would have good expectations of follow through in terms of getting work done. We were their guys on the ground, right? And we just weren't quite cutting it. There were times where they came into town. Like, for example, we were doing the renovation of a house that we bought together, and they were coming into town and they were going to inspect that house along with a bunch of other stuff. And we took the contractor's word for it that the work had been done, right? Rookie mistake. So we all show up at that house, we walk in, and none of the work was done, even though we had said that it was done. And that seems really simple, but like, that was a learning lesson, right? Like you always gotta make sure that the work is getting done. You can't, I'm a contractor also. I own a construction company, and we do third-party work, but, so, for all your contractors out there, like, forgive me, but it's like, you can't trust the word of a contractor. You can't really trust the word. You have to see it and make sure that the work is done.
Yeah, that makes sense. And so that kind of makes sense. I mean, you started out in a period of, massive growth potential where things were available for pennies on the dollar, definitely capitalized on it, but with some of those lessons in place, might have been able to capitalize more. Fortunately, you're going through, we're in that time again. So we're probably going to be positioned to capitalize on that, on those lessons. So tell me a little bit about the partnership you brought together. So just one thing I picked up on was you started buying multifamily, you partnered up with two individuals in 2017, and you're still together in 2024. And I just being an operator myself, 2017 through about 2019 were pretty much golden, right? Then we
Mm-hmm.
endured COVID. Then I'm going to say endured because it did make it harder to put deals together. We endured the rapid price growth of 2021. And then we're all aware 2022 and 2023, the interest rate, we'll just say changes that the Fed
Mm-hmm.
has done in response to inflation. So tell me about that partnership. And I mean, you're clearly a strong partnership and probably all in the right roles because you're still together. You guys have been battle tested and literally through hell and back the last few years. So tell me about how y'all came together, whether you knew them before or not, and how you've kind of structured that and organized it, and maybe some of the tough times that y'all went through, because it's not been an easy, few years to be an operator.
Yeah, when and this could be applicable to folks who maybe are interested in getting into the game or scaling up. When I transitioned from single family to multifamily, I wanted to go big. I didn't want to buy um, my. I preferred to buy 200 unit properties rather than a 20 unit property. That was just my goal or my vision. And um, I needed balance sheet support, and I needed connection.
Yeah.
And I didn't have a robust following of investors. So I had a connection and a relationship with a gentleman, the H, and um, came from a family, a high net worth family, and was running the family business. And he and I had transacted. It was kind of serendipitous, where he had a friend who was in the single family business. He had invested in like 25 houses. And unfortunately, his friend who managed that investment, and I think brought him the investment and was managing it for him, had a heart attack and died unexpectedly one day.
Wow.
So this guy called me up and said, I've got these 25 houses in Detroit and I don't know what to do with them. And so I bought them from him. You know, I ended up selling them like the same day, but we transacted. We found, besides having a personal relationship, that we could negotiate well together. And so I approached him when I wanted to do this multifamily piece and say, I need a partner. And he was very well connected within the community here in southeastern Michigan, and he never asked anybody from his circle to invest money, but he would provide a warm introduction for me. I talked to my partner. This is what we're doing. I think it'd be great if you'd find it interesting if you guys get together. That's a really warm introduction from this guy um, to other people. And so then he also had met the S. And so Hanan is his name. He's the H, and Shmulik, or Shmuel, is in Israel. He's the S. And Shmulik is, he'd bought like 1,200 units in Detroit randomly with another partner. That partnership ran its course. He had a little following of investors. And so we kind of put it together where it was like, okay, I'd find the deals, I'd be the operator, and Hanan would provide balance sheet or support and relationship support. And Shmulik would bring the investors, right? And that's the way it worked for the first handful of deals. And as I started spooling up and building credibility here in the U.S. and gaining and growing an investor pool. So that's why we came together. I mean, I think that my partners have been great partners because they trust me and we trust each other, and they've never really, they have their own opinions about things, but they respect the fact that I'm the guy on the ground, the managing partner. And we may have a lively debate at times, but they've never not given me what I believe we need in the business. to be successful. And so, the respect and the partnership turned into friendship and family. And, they're both 20 years older than me. So, I'm sure there is evolution already from where it was to where it is today. And I'm sure that it'll continue to evolve. But we're all aware of it and we talk about it openly. And so, you know, we'll always be doing something together. The question will be, what it'll look like 10 years from now.
Yeah, I love all of that. And what folks, what I hope you heard is number one, he's got some people who are many years his senior, which is great. They're going to have seen different things than him, and he he's kind of put aces in places, right? You don't bring a partnership together of four of the same dude, right? Who do the same
Right.
thing well. You bring
Right.
someone who is good as they structured, good with literally the operational part, running the business. And that's not common for people much more senior to find a horse who can really run the business. There's a lot of day to day, and Gideon's got that energy, you can tell. And then you've got a balance sheet partner who is like basically guaranteeing everything, putting up his wealth, maintaining covenants that lenders require
Right.
to optimize financing, all that kind of stuff. And then you got a money guy, right? And all of those things, like that is like the core minimum three of what you need to have to do this. And so aces in places is one thing, but one thing that I really see partnerships go sideways a lot in is no clear decision maker or control, right? We do it a little differently. We have 5 managing partners in Quattro, but they're all over a different lane. And so, the authority of each partner is driven over that lane. Whereas yours is, okay, hey, we're all going to debate and maybe we have some voting on things. But at the end of the day, I'm making the decisions on the ground. They trust that you're the one who sees the need because you're there. And so there is a clear level of respect. There's a clear level of delineation of, I don't want to say power, but decision-making authority. And that's what makes for a healthy partnership, So I don't know if you want to add anything to that, but just my observations listening to you talk.
Yeah. I mean, I think that, going back to the beginning of what you were saying, it's like, you said aces in places, right?
Yeah,
And
I've got
so
a lot of corny
what's
phrases like that, Gideon.
but it's like, what's the strategy that you want to, look at? There's some folks that want to do it on their own, and build organically and not have partners and not give it away. I felt that I'd rather have a smaller piece of a bigger pie, and I don't think that one is necessarily better than the next. That was just my philosophy, and it still is my philosophy. And I don't need to be the biggest operator in the country. I just want my little sliver of the
Yeah.
opportunity.
Yeah, that makes sense. And we're going to get to what's going on today a little bit, and maybe we'll kind of banter back and forth on this. I know we both have experience, but given that we've been through some tougher times recently, just with
Yeah.
changes, changes in the winds is really all this is. It is very beneficial. I know I value having our partnership structure the way it is because if you are the CEO type and you really don't have those partners behind you, it's just you and you have a bunch of employees. That's great, more power to you. But you're all by yourself with these tough decisions. You don't really. You hopefully have some advisors and mentors or someone you can bounce ideas off of. But it's very lonely when things start to go not according to plan or the winds shift a little bit and you got to figure
Right.
out how to tack the sails if you don't have those partnerships to have, as you put it, lively debates with, right? So let's transition the show a little bit. Let's spend the rest of the time talking a little bit about, what you have experienced over the last several years, just with, things were going really great. We were following fundamentals and the winds have shifted. So what does that mean for you as an operator? And I may chime in as well with some similar or alternative experience.
Yeah. I mean, I think that the last 2 years has made a lot of us um, realize. Let me say it a different way. A lot of tough lessons to have been learned over the last 2 years. I think, at least for me, speaking for myself, but I know because I'm connected with a lot of other people that do what I do or in real estate that we're all kind of in one way, shape, or form dealing with similar circumstances. So, I'm
Yeah.
riding high. It's 2020, 2021. Built a great investor base. I don't want to say that it was easy to raise money, but we were very successful at raising money, but probably easier to raise money than it is today.
Yeah.
And because, we're coming off of 8 years of positive real estate trend, right? From rent growth to appreciation and low interest rates. So in 2021, we had a great year. We purchased 10 properties. And towards the end of 2021, we purchased about four with floating rate bridge debt. And, we were underwriting what we thought conservatively. We were following the forward curve, which is, an algorithm that predicts what short-term interest rates are going to be, that floating rate debt is tied to. At the time it was LIBOR, now it's SOFR. And so we were modeling that up and following the Fed's guidance. And we got into some serious properties, like large unit counts, $100 million acquisitions, things like that. And it was, the world was my oyster, right? And then you fast forward 6 months from, December 2021, and all of a sudden, short-term rates were, that were supposed to maybe go up by like 30 or 40 basis points, went up by 300 to 400 basis points, right? And all of a sudden, I've got $350 million worth of floating rate debt, and a lot of like post-COVID, what I call haze stuff. So various municipalities are very slow on evictions, and I've got big value add programs, and occupancy is softening a bit, and debt service payments are, very high, and I've got kind of rate caps on some, not rate caps on others. Just basically the business plans are just upside down, right?
Yeah.
So I'm riding high in 2021 thinking I could do no wrong. And then all of a sudden I'm like, okay, like the rubber hits the road here. The market has ended. From the day I bought my first property in 2017, I was looking forward to the next cycle. I was like, I know we've been in the cycle for a while. I'm looking forward to the next one so we can really take advantage. I'd never really thought that I'd get caught in it. Right. And so, I did. I bought at the top. I bought with some, and so what it did was it really forced us to efficiency. It really forced my team to dig in, roll up their sleeves, and to work through adversity. And we ended up realizing that we were going to need help from our lenders. And last October, we started negotiating with our lender proactively and in good faith to renegotiate all of that debt, or at least modify it to give us some more time. And I'm grateful to say that at the end of March, we were able to close that modification on all that bridge. Luckily, I was with the same lender, so I think it was as important to them that we modified it as it was to me.
Yeah.
And so we're living to fight another day. But it's not as all like fun as it might seem all the time. Right. I mean, to have 6, 7, 8,000 units and to have this big operation, I'm super grateful for. Right. But I think that people might assume that, I know that I would have assumed that, once I get there, I won't have a care in the world. And the truth is that, there's a lot more cares, not, whether the market turns or not, there's a lot of responsibility around having that many units, having that many people living, calling those units their homes, taking care of that and respecting that, providing safe, clean, and affordably priced places for people to call home. All the investors, being a fiduciary to your investors, and lots of investors. It can be heavy at times, so it's like, careful what you wish for. I accept it with grace and humility, and I wouldn't change it. But like, the truth is that it's heavy at times.
And that's not to be taken lightly. So folks, whether we have about half of you out there who are investors in deals like these, and about the other half of you, which are young aspiring operators who are growing in your own right and probably experiencing some of the same stuff we are very vulnerably talking about here. It's not to be taken lightly. Like, you have to remember, if you're in this to make money, get out. Just get out, because there are easier ways to make money. And to Gideon's point, you are first and foremost a fiduciary to any money, not just investors, debt as well. Like, the debt you take on, you're a fiduciary to that investor. It's all investors, unless you're using your own money. You are responsible for the livelihood, not the livelihood, but the safety, the affordability, and the quality of the housing product you're providing to families who are doing their kids' homework around the dinner table on your property.
Right.
I mean, stuff like
Right.
that. So that is not to be taken lightly. And look, I'll give you some community here, right? We're about half the size of what you've grown, but very similar fashion, where we have a good chunk of it where we were doing some good fixed rate long-term debt. And man, I'm wishing I had done more of that, because that 3% rate is just amazing right now, right? And
Exactly.
those business
Yep.
plans where things were funded have been great. But our experience, Gideon, was, we did start to dabble in some bridge debt, first smaller ones and then some bigger ones, mostly 2021 and early 2022. And, but, we were pretty scared of it. Right. So we're like, well, like it makes more sense to get the construction money and that was really why. It was like, okay, they'll not only give you money to buy it, they'll give you most of the construction money. And that just makes a better equity play for the investors. Right.
That's right.
But we are scared of the unknown. So we were like, well, we don't control it. So how can we mitigate the risk? So, kind of before it was cool, and I'm sure it sounds like you were doing some of this too, we were buying really low strike rate caps, because we knew rates were going to go up. We had no idea it was going to touch 5.5, on the index rate.
Right.
But I mean, it was 0.5, 0.3 when we were starting, and, plus their spread.
Right.
So, I mean, our bridge loan was 3.5%. It was great money, right? It was as low or lower than the agency debt. And so we figured, well, we'll just put a 1 or a 1.5% strike on top of it, really mitigate that upside of the rate, which was great. That turned out to be a great investment, because when we bought those, it was still a nominal price of like 30 grand. And for those of you listening, the rate cap is just, you have your floating rate index, you have a spread or a percentage on top of that makes your total rate. So if the floating rate is 2% and your spread is 3, your all-in rate is 5. Well, that 2% moves around. It might one month be 2.1, then 2.3, then 1.9. It moves around. Well, our experience has been, it's just gone straight up. It went from 0.5 to 5.5, I think, at the peak in a year. And so that was pretty much enough to blow up any business plan you don't underwrite for something that big of a change. That is a 50-year debt event. Like, people who are our mentors, Gideon and me, haven't seen this happen.
That's right.
So it was a major thing for us to go through. And we were moderately leveraging, but so we weren't over leveraged on things either. But where we found the problem, Gideon, is, let's just say on a given project, we have an $18 million loan, and 4 of that is construction money. Right. So the way these loans work is they give you, as they'll give you the 14 up front to buy the property. They'll hold on to the other 4, and you have to go do the work, prove you did the work, submit a draw request, usually in $250,000 to $500,000 chunks, and they will send it back to you. So what do? We say, okay, well, let's keep $1 million of that 25% liquid, and we'll use that as our working capital. We'll spend it down, do the work, and then send the draw, get it back, do it again. Well, guess what? They never sent the money. It didn't matter that we did the work, we hit pro forma, and we were meeting loan obligations. They didn't fund the money. Right. And
Wow.
And that happened on about 3 different projects. So overnight, we went from being fully funded, Gideon, to having about a $10 million cash problem, because not only we're used to spending money while we're waiting on the draw coming back.
Yeah.
By the time we figured out it wasn't coming back, we were 6 months into talking with them, and we'd spent all the cash.
That's awful.
So right there with you. So gosh, tell me a little more about the workout. Because what I want to accentuate here is that your loan documents are law, but there's an old saying that if you owe the bank, let's just say $10,000, that's your problem.
Right.
If you owe the bank $10 million, sometimes it's their problem. If you owe the bank $100 million, it's really their problem, right? So the idea is you probably had the situation where you had enough debt with Arbor that you basically had to approach them proactively and say, look, there is no physical way we can pay this debt off on the terms that you're requesting, which is usually 1 to 3 years, probably 2 or 3 with some extensions you got to qualify for. So how did that conversation go? What was your thought when you were approaching them proactively? Because you were seeking a modification. You were seeking to change the rules because the rules of the game had changed, right?
That's right. That's right. So we led under the assumption that the bank didn't want to take the properties back. That's what we assumed, and I think that that's generally the case. And the lender was even saying it. We can take these properties back. We don't want to, and we knew that it would cost them more money than negotiating with us if they took it back. So, yeah, I mean, we also there are 5 properties. There were 2 that we didn't get rate caps on where we self-insured, which was boom, lesson learned on that one, right? Don't trust the forward curve.
By the way, the Fed doesn't even know what the Fed's going to do tomorrow, so don't trust the Fed's predictions.
Right. I mean, yeah, the Fed said, there was a prediction of the Fed where interest rates would be in 2023, and guess what? It's like 450 basis points higher than what they thought it would be.
Yeah. And I say that tongue in cheek, Gideon, because I also looked at that curve, right? But now I know, okay, that doesn't mean anything. They will do what they have to do in the moment. So anyway, please continue.
Right. That's right. So, a lot of lessons, a lot of great lessons. I wish that they weren't so costly, but that's a lesson. We also had low strike rate, rate caps, like you mentioned. And they were typically 2-year terms, right? So we saw that, for example, we had 2 properties that we purchased in late 2021, December of 2021. We were approaching falling off a ledge from going with the rate cap, a 5.25% interest rate to a 9.25% interest rate on an aggregate of like $180 million of debt that the properties couldn't support, right? So, we just went to them and just shined a light on the reality of the situation and asked them for relief in the form of lowering interest rates and some other asks. What we asked for and what we got are very much different, but what the lender was willing to do was if we were willing to bring more money to the table to cover shortfalls at the properties, they would work with us to provide relief for some of the shortfall as well through a combination of mortgage interest rate accrual, which means if my interest rate is 8%, maybe I'm only paying 6%, and the other 2 gets tacked onto the back of the loan. Some other additional creative funding to cover shortfall. And we modeled out in a very conservative way over the next 3 years. Where do we need to get to in the next 3 years? Where do interest rates need to be? And we didn't want to bet on interest rates. So could we in 3 years through NOI growth, conservative NOI growth and stabilization, refinance these properties at today's interest rates and get out of this bridge? And the answer was yes. So we're like, well, okay, we just need to get more time. We needed to, and so I had to raise more money from my investors and from outside sources to buy more time, and I did that instead of a traditional capital call because I knew I wouldn't raise all the money I needed. I created a new equity tranche. I structured it as preferred above the original investors, and I gave all my original investors first right to come in. And so the new money was super safe, and the goal is, because I know that in talking to a lot of folks much more experienced than I am, and I've got 25 years of real estate investing under me, guys who have been doing it for 2, 3, sometimes 4 decades more than I have at this point, and been through multiple cycles, that time heals issues like this. So if I can buy just 3 years to get out of the bridge loans, and then we get into fixed rate debt and we just operate again for another maybe 3, 5, 7 10 years, we'll be in a position where, look, these deals won't ever be what we thought they would be, but I can preserve everyone's capital and maybe even make some money on the backside too. Um, and and so that's my mission now on these specific
Yeah.
deals. The unfortunate thing is that, I've got 20 communities and I've got 5 properties that I'm spending 80% of my time paying attention to, you know, um, and we love going after new opportunity, but I'm sure that you and a lot of the listeners are experiencing what we are, which is, there's still a spread between bid and ask, right? There's
That's
not,
right.
I think we expected there to be a little bit more distress at this point. And there's not. And I think it's because lenders are doing what they just did with me. I think that there are buying opportunities coming, but it's just they're a little fewer and far between than what I would prefer at this point. And so,
Yeah.
we're kind of stalled out a little bit. We're doing the occasional small deal here and there, but um, the growth trajectory has leveled out a bit, and
Yeah. Yeah.
and we're kind of just more focusing on operational. I think it's good and bad, right? Like when times are tough, light is shined on inefficiency, right?
That's right.
And so this will be a great time for us and myself to learn and fortify and get better at what we do, and be really ready to rock and roll on the next wave, whenever it does come.
I couldn't have said it better myself, Gideon. And as we come to a conclusion on this, I mean, I agree with you. We aren't really, we all thought there'd be a ton of distress in the streets, blood in the streets everywhere. I think that, to your point, has really manifested itself in holding the line with lenders modifying loans and people putting more cash into deals. You mentioned a pref equity tranche. We did a similar thing where we had that cash shortfall I told you about. We started a debt fund, which is, for all intents and purposes, mezzanine debt and pref equity are kind of the same thing. But
Sure.
we did a similar thing to instead of capital calling the deal, bring temporary cash in to solve a temporary problem. And so I think between that and lenders kind of being willing to, understand that, well, the prior business plan is out the window, fundamentals are still good, but here's what we've got to do, so that's probably holding the line on the distress. Now there has been, and here's the thing, folks, here's why you're not seeing all the blood in the streets. A good chunk of deals have fixed rate long-term debt at 3% or 4% or lower on it, right? So that they're not doing anything. They're not selling the deal. They're probably fine as long as they bought the deal right and have managed it at all good. The fixed rate or the floating rate stuff, that's where a good percentage of them are going to modify, because if that bridge lender has every loan go bad, well, they're out of business, right? That's a problem. They're not an operator. And, I think the second part of that is the isolated distress sales you're seeing are those who, they try to work with the lender. Maybe they're not a great operator. So talking about shining light on inefficiency, every lender is looking, like even properties we have going well, we were getting excessive requests last year for all these different reports. As you could tell, they were going through and evaluating the portfolio for risk, right?
Yep.
So if you're not a good operator, or you're invested with a bad operator who's not doing the work, who's not managing the deal well, that is probably not going to get restructured. And so the lender is probably going to say, hey, you need to buy this loan down, AKA bring money to the table and pay me down and lower my risk. Or we're gonna force you to sell the property or take it from you. And those are the ones you see hitting the market right now, where it is a distressed asset. The lender's unwilling to work with them. And so if you take one lesson away from what Gideon and I have said here, it is that, look, the market changes. The market is cyclical. We're unfortunately experiencing a 50-year market event right now, but the winds have changed. So the way to make it through is to adjust, to pivot, to focus on efficiency, to try to change the rules where the rules have changed on you, negotiate, all that kind of stuff. But if you remember nothing else, you said it in a way that time heals deals. I say it in a way that the only way you get in trouble in real estate is you run out of time or money, right? So as long as you can manage to not run out of those two things with whatever you got to do, You can make it through, and a couple of years down the road, this is all it's going to normalize somewhere. It probably won't be 2% debt, 3% debt like we saw. It'll normalize, right? So, Gideon, any final thoughts on that before I take us to our ending questions? I said a lot there.
No, that was great. I mean, I think that it's important for people to know in that markets shift, that markets change, and out of situations like today, there's going to be a lot of opportunities. We just don't exactly know what they look like yet, and there'll be another run up, and hopefully we'll be a little bit wiser and more prepared to take some chips off the table when things get frothy.
Yeah, right there with you. Well, let's ask a couple of questions and then get you back to running that enterprise. So, Gideon, first question: what is your superpower, life or business, and how does it serve you well?
Well, I don't play the guitar or break dance, but I seem to be able to build relationships pretty quickly. People like and trust me relatively quickly, and so I'm fortunate because I love interaction and relationships with people. But that's really helped me in business from a sales perspective, capital raising, and relationship building to be able to build large scale enterprises like I have.
Yeah, that's a great one. I think we've seen that illustrated here in how you carry yourself and the things we've talked about. So let's flip that coin over and let's talk about your biggest failure. Again, life or business, but more importantly, what'd you learn from it?
There was a time earlier in my career. So I'm 44, around my early 30s, where I really was focused on work so much and entitlement within my family, within my marriage, where I'm working so hard and providing, so I'm entitled to do whatever I want, whenever I want, and luckily my wife was patient and stuck around, but I had to go through a personal awakening to realize that my children want me around and present. My wife wants me around and present, probably more than a big pile of money. And so money's great, and money makes things easier and helps create experiences. But my biggest mistake would be prioritizing that over the people that I care about for a period of time early on in my career, and almost losing what I thought was most important.
That is a incredible piece of awareness. Dude, I shared that. I went through a phase where it was all about rising and getting work done. And then someone told me through a series of lessons that they didn't ask you for that. You can convince yourself you're doing it for them, but they didn't ask you for that. They asked for you. Right. And so to your point, what is a big pile of money if your family hates you? So
I also find that balance is better. And when I stop really reaching for it or working so hard for it, and it comes.
Yeah, it does. It does.
Yeah.
Thank you for being vulnerable on that one. Next question. One of Quattro's 4 pillars is philanthropy, right? People, property, profits, and philanthropy, coming back and taking care of people. So I love to give our guests the opportunity to just share your heart. What are you doing with your time or your talents or your treasures? To just give back to the world, and in some cases we've actually seen in the comments people giving on your behalf to said charity. So what is that?
That's awesome. So my wife and I donate our money to different charities, not any one specifically, our kids' school, for those for those on scholarship. We created a scholarship at my at Syracuse University because I got financial aid when I went there, and so trying to pay that forward. Currently, I have a friend who's a rabbi. He's a young guy who's very passionate, and he's looking to buy some land and build a community center for a Jewish community here in Michigan. And so I'm providing my expertise in real estate, land acquisition, construction development as part of his advisory team. And that's my way of just giving back because I feel like I'm relatively good or experienced at what I do.
Yeah.
I also, through that experience and awakening that I mentioned, I work a program of recovery, and so I help other folks who are having similar experiences and challenges in their life. I lead, sponsor, mentor them to hopefully help them overcome those challenges as well.
Man, that is time, talents, and treasures. So thank you for sharing all of that together, brother. Last
Chad.
question. It's time for our shameless plug. So, anything on your mind that you'd love to share with the audience that you're working on or excited about or anything of that sort?
I think that I'm building. I'm starting to build a brand. I'm starting to build awareness around Gideon and my ability to scale. Right, scaling single family, scaling multifamily, and through doing these podcasts, folks have reached out to me for some time. Right, and I don't have a coaching business or anything like that, but I think that starting to speak to people who are interested or already in multifamily wanting to scale up. I'm interested in having a conversation with you because, I can't be in every market at every single time. I can't see every deal that might be worthwhile looking at. And so if there are folks out there looking to get into the business or in it, but maybe need a joint venture partner, to come in with some balance sheet capabilities for a really great deal that might just be a little bit outside of your reach right now, shoot me an email at gideon@gshrealestate.com, or check out our website and fill out an inquiry, which is www.gshrealestate.com.
I love that way to pay it forward. And also look, folks, this is the kind of coaching I love right here, where it's not a buy in and go to a bunch of seminars, which is great too, but you're going to help each other, right? Like they're going to benefit from your knowledge and your experience and your partners, and you're going to benefit from being able to be in however many places at once with support on the ground. So no better way to learn than by doing. Brother, thank you for coming on the show, sharing your wisdom, being vulnerable with me. I love when we get real and raw on these things and talk about what's really going on out there. And, folks, remember that this is a long-term game. The fundamentals of real estate are still very sound. The temporary debt crisis will pass, and everything will go back to some new normal in the future. So anyway, last soapbox moment. Gideon, appreciate you, brother. Thanks for coming.
Appreciate you, Chad. Thanks so much.
All right, everybody. This has been another episode of the Real Estate Runway podcast. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com and scroll down for more info. Until next time, this is the Real Estate Runway podcast.